Here is a crisp, real $1 American bill, and every single dollar that you receive gets taxed, and every single time you spend money on things, you also pay some sort of tax, and that person who receives the money that you spend pays taxes on that. And essentially it's an infinite loop of that money getting taxed forever, until eventually that $1 bill disappears. And although my magic skills are lacking a little bit, even though I know you wouldn't say that to me, using Baselane, today's video sponsor to help manage your rental properties and do accounting, can feel like magic. What's up? My name's Avery, and I absolutely love real estate, as well as the tax benefits that you receive from doing a lot of things associated with real estate, which is why myself, I am a realtor and a real estate investor in the Raleigh, Durham area of North Carolina. So sit back, scroll down, make that thumbs up button blue, and listen to 8 fantastic ways that you can get amazing tax benefits through real estate. Before we get started in talking about all these tax benefits, I do just want to mention I'm a random guy on YouTube. I am not a CPA, although I do employ a CPA in order to complete my taxes every single year. So that first thing we're going to talk about is very simple, is called a deduction. And tax deductions are not specific to real estate, and you can use them any type of business that you have. Tax deductions are very simple. If you have an ordinary and necessary business expense, it can lower your taxable income. So very simply, if you earned $1,000 and you spent $250 keeping your business in business, then you can lower your taxable income to $750 for that year. And contrary to popular belief, just because you spent $250 on your business does not mean you get a $250 refund. It just means that you're paying a little bit less in tax because you had to spend that money in order to keep your business going. And these expenses can't be random, and they actually have to make sense towards your business. So because I'm a YouTube star, I have to get haircuts because, I really like how my hair looks. But I can't deduct my haircut cost because I need to have a haircut in order to live. It's not specific to YouTube, so I couldn't write off that cost. For example, you couldn't have a short-term rental property and then utilize the backyard for your wedding venue, and then, the entire cost of your wedding you could write off. Maybe renting that to yourself as you have the business of your rental property that the name is in, and then spending the money to stay there for those few nights, you could write that off no problem. But if you're spending $30,000 on food, guests, and all that stuff, that is not going to be a tax write-off. Another bit of misinformation that is always seeming to be out there is you do not need to have an LLC in order to take deductions. If you just bought a property in your own name and have regular, ordinary, and necessary business expenses, you can deduct that as long as you just have that business, and you can just be a sole proprietor, which just means you have the property in your name. Number 2, and one really awesome benefit from investing in real estate, would be getting a cash-out refinance. Now, a cash-out refinance doesn't sound like anything to do with tax because it's something that you do when you refinance your property, get new loan terms and all that good stuff, and then you take some money out and now your loan is a little bit higher. But the cool thing about your loan being a little bit higher and you receiving income is that you're not taxed on any of that income. Because from the eyes of the IRS, you are just taking equity from your property, giving yourself a check more or less, while the bank is writing you one, and now you have a higher loan that you promised to pay back. And debt is not taxed, so you do not have to pay any tax on that income that you have earned. Doing a cash out refinance is really awesome because instead of selling your property, you can just do that cash out refinance, which is a non-taxable event. Selling your property, you will have to pay capital gains tax and potentially your ordinary income tax, depending on how long you own that property for. So cash out refi is just a way for you to access your money completely free. Again, as I mentioned, you're going to go from a lower loan amount to a higher loan amount, depending on the interest rate that you received between the original loan and the new loan that you got. Your monthly mortgage could be higher. So obviously if you do a cash out refi event, you want to make sure that the money coming in from your property still covers that debt. Number 3, and definitely one of the most awesome things about real estate, is depreciation. Yes, your property on average will appreciate 3% every single year. Obviously it's highly dependent on where you buy that property and the quality of that property and a number of other things, but mainly about the location. But the other really cool thing, as your property increases in value when you're looking at the Zestimate and just the general value over time, your property in the eyes of the IRS depreciates. So depreciation is very simple. The things that you own in that asset will depreciate and deteriorate over time. So the IRS says that you can take some of that money back because the useful life of that property and the things associated with that property are, deteriorating. And again, I'm not a CPA, but very simply, you can take all of the things associated with the property, divide them by 27.5 years, and then you get a little bit of a cost of a depreciation expense, which again is some type of deduction that gets deducted from your total taxable income every single year. One caveat here is when you do sell that property, you do have to recapture that depreciation that you've taken from the property upon sale. But in some of the later steps we're going to talk about, you can completely wipe that out and never pay it. Number 4, and this is just a different type of depreciation, would be a cost segregation study. Now, I did my first ever cost segregation study in 2023, and it allowed me, instead of taking a $90 loss on my property, to take over a $50,000 loss on my rental property business, even though that rental property business, the specific rental property, made me over $16,000 in cash flow that year. Cost segregation study, just to boil it down in a simple way, I talked about the 27.5 years of useful life that your whole property, really just whatever the IRS says, that's the useful life of the things in your property. A cost segregation study, an engineer will come in, look at all the specific items. They'll look at the furniture if it's a short-term rental, the appliances, anything that's associated with having built your home. And they'll, instead of doing 27.5 years for anything, they'll just specify each specific item and how many years of useful life that they'll have, so you can speed up a lot of that depreciation and get it earlier in year 1 or some of the earlier years. Obviously, a roof, HVAC, and other big mechanical items are going to last longer than appliances or other items that tend to die a little bit earlier. So that's really the whole point of this. And that's why, instead of just taking that $90 loss that I could have gotten in year 1 for my short-term rental, I was able to get over a $50,000 loss on paper while still making a lot of money on that property. And before we move on, let's talk about today's video sponsor, Baselane. Baselane is the #1 banking platform built for independent real estate investors, so you can reduce your busy work. Baselane offers a checking account with high rewards, such as earning up to 5% cash back on debit card spending with no monthly fees. It's also really easy to keep track of all your properties with a simplified view and know how much cash flow that you're making in your portfolio. Baselane also offers some property management features like automated rental collection, which is my personal favorite, to your Baselane account. And in that Baselane account, you can earn up to 4.19% annual percentage yield, or APY, on all your deposits. Plus, that account has no monthly fees or minimums. So if you want to join 40,000 investors who trust Baselane, just scroll down to the link in my description or go to baselane.com/Avery for a chance to win a $500 Amazon gift card. That's BASELANE.com/AVERY. Number 5 would be the short-term rental tax loophole. And this is me expanding on the cost segregation study, because not just because you own a rental property should you do a cost segregation study. It does not make sense in every single scenario. Here's one of those scenarios where it would make sense. I have a W-2 active income job, and because I own and operate a few short-term rentals, that short-term rental income is classified as active from the IRS perspective because I have passed a few tests and I materially participate in that property. If you want to learn more about the short-term rental tax loophole, I will put it in the description below. Did an entire video about how I was able to get this massive deduction. And so because I then can classify my short-term rental income as active income and I have active income on my job, you are able to offset any active income losses with any positive active income. And in my W-2 job, I make a lot of positive active income. And because I did this awesome cost segregation study, I just told you before, I have this massive loss. So that big loss that I took with my short-term rental can offset a lot of the taxes that I paid with my W-2 job. So that's one way that you can use a cost segregation study. And in the next steps, we're going to talk about other ways that you can utilize one if you have a different status. And number 6, we reveal that different status as being a real estate professional. As you noted in number 5, talking about the STR tax loophole, I really wanted to harp in on the fact that it was active W-2 income and active short-term rental income, because typically rental income that you receive on just a standard long-term rental property is considered passive. And if you have a W-2 active job, you cannot offset passive losses that you might have with your rental property on active income. If you hit real estate professional status, you are able to take any active income that you make. So let's say you're a real estate agent and you absolutely crush it and you make $500,000 in gross commission income and you're just rolling in all the Benjamins, but you're also cool and smart, so you're doing all these awesome real estate investing projects on the side. So any of those passive losses that you're getting from the real estate investing, because you're doing all of these renovations, setting the properties up, and then they're just starting to make money, can offset a lot of that active income that you make on that other side of the job with being a real estate agent. Also, just a reminder, I am a real estate agent in the Raleigh, Durham area of North Carolina. If you need help, I'd be happy to help you. There are a few rules similar to the STR tax loophole that you have to pass in order to be considered a real estate professional. Having a W-2 job, it makes it very difficult in order for you to be a real estate professional. The example that I gave of being a real estate agent and investing in real estate is one of the easier ways because you have to have 750 hours of you being in the world of real estate. You can also be a property manager, and it also has to be the primary thing that you are working on. So that's why it's hard, because you can't really delegate your W-2 job as a side job. Maybe you can, depending on the amount that you work, but it's definitely a little bit harder to prove to the IRS. So I don't have all of the rules in front of me, but there are a few things you have to do in order to qualify as that real estate professional. But once you do, a lot of great tax benefits open up for you. And so to really close it out with that cost segregation study, you could do a cost segregation study on properties that you own as long-term rentals and not short-term rentals, because that rental income is still classified as passive income. So you can make a bunch of passive income from a duplex that you bought a number of years ago, and then on paper you can get massive passive losses because you had done a cost segregation study, so you can offset that active income with those cool passive losses. Real estate is awesome. All right, number 7 would be the 1031 exchange. And earlier I talked about depreciation, and then when you sell your property, you have depreciation recapture. With a 1031 exchange, theoretically, you never have to pay that depreciation back. A 1031 exchange is very simple. It is the tax code in which allows you to sell your rental property tax deferred. That doesn't mean tax free. When you sell it, you are not paying taxes at the event of that sale, as long as you do a few things. You have to buy a new property. I believe it's within 180 days. You have to identify which property that you are buying within 90 days of selling that first one. But essentially, just to keep it simple, you sell property A, you made $100,000 on the sale of property A, you're putting those $100,000 into property B. Instead of paying tax on that $100,000, it's just now in that new property, and you don't have to pay tax on it at that time. If you own property B for 10 years and then sell it for $1 million in profit, and you just purely sell it and are trying to cash out, then you would have to pay tax on all of that amount of money that you then made from property A through selling property B. The cool thing here, as I mentioned with depreciation recapture, all of that depreciation deductions that you took on property A, when you're moving from property A into property B with all of those funds, you do not have to pay the depreciation recapture. And you could just continue doing 1031 exchanges until you die, and then you could pass that money off to your heirs and those properties off to your heirs, and then they just start at a stepped up basis, so they also don't pay that depreciation recapture or pay that tax. This is something a lot of rich people do, called buy, borrow, die, where you buy assets, borrow against them, die, and hand them off to your kids, and no one pays tax. Now, that was obviously a lot more simple than it is in practice. I'm just a guy on YouTube who's telling you a few things. I'm not a CPA. I'm really just hoping that you like my videos. Number 8 would be the fact that the income that you're earning is passive. Now, we talked about with a short-term rental that it can be active income, but for a majority of properties that you're going to own, the rental income is going to be considered passive. And passive income is taxed differently than active income. Active income is taxed at your ordinary income tax rate. So if you make a lot of money, you pay a lot of taxes. With passive income, you pay a little bit less of a tax rate. Now, that's pretty cool. You are earning passive income and you're paying less tax, but obviously it's not so passive to the point where you're a slumlord. You're still taking good care of your properties, respecting your tenants, and you're making sure that you're making the world a little bit of a better place. That's it. There you have it. Those are 8 awesome ways that you can get some amazing tax benefits through the world of investing in real estate. And I hope you guys liked that video, and if you did and you want to learn more about investing in real estate or buying property or selling your property in the Triangle area of North Carolina, and you need someone to help, definitely subscribe or hit me with the email in the description below, and I'll be sure to reach back out to you. So thanks again for watching, and more wealth is coming your way.